FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome, and you are listening to the Financial Survival Network. I'm Kerry Lutz, and guess what? It's Monday, April 9th, 2018. As always, we invite you to participate in the show. Email us, kl@kerrylutz.com, or use the hotline 914-424-4142 and leave your comments there. Well, it's been 10 years since the great crash of '08. And what has happened during that time? Well, one thing that hasn't happened is investors putting all their money back in the market. If you're an individual investor, you know what I mean, distrust running rampant. Well, here to discuss it is Dee Carter of Carter Financial, located in Midland, Texas. Dee, welcome back to the show.
Hey, it's good to be back with you, Kerry. Thanks for calling.
Hey, so it's been 10 years. And there's still a lot of distrust, uncertainty, lack of confidence in individual investors insofar as investing in the markets, even though they're invested in pension plans and 401ks, et cetera. Is that justified? And what should you be doing as an individual investor?
I really think it's justified, and what we've run across over the last 10 years. I was around when that thing happened the last time. In fact, I feel sometimes like I've been around since about the same time baseball started. But it's I've seen my clients they're hesitant to get back in the market for 2 reasons. Number one, they know more about the market now than they've ever known before in their lives. They woke up one morning and realized back in 2008 or 2009 that 40 to 50% of their money was gone if they were in the market by themselves, or if they were in a 401k and they had money in a plan there. They woke up and all of a sudden they were down 40 to 50%. They didn't want that to happen again. So a lot of people, and more people are doing this, as I know you're aware, they're literally going to the internet and they're learning more about how the market actually works. They're going back and taking a look at the history of the market and what it's done over the last 125 to 30 years. They're learning about cycles. They're learning about the income cycles and the upsides and the downsides, the bulls and the bears. And we're not talking about the regular bull and bear markets. We're talking about the secular bull and bear market, and those run longer. And they're learning about those things. And as a result, they see what's taking place. They're more educated. They're more skeptical, obviously, because they've lost money. And so they're hesitant to go in there, helter-skelter, pell-mell after the market anymore because of what happened to them once before. So they're being a little bit more careful with their money. They're looking more at income-type products as opposed to growth. They've realized that income products can bring you a really nice return and not have the market risk that they have with common stocks. So people are just kind of staying out. They're more educated. Once burned, twice shy. They literally don't want to get back in there. They've watched the money being put into by the government. Somebody went down in the cellar of the Fed building or the Treasury and started printing off dollar bills or $100 bills and started throwing it at the companies that were out there that lost all that money. And what those companies did with the money, instead of lowering their prices, they turned around and bought their own stock. And that's fake. That's like putting money in one pocket and taking it out and putting in the other and saying, hey, look how much money I made. And the people are really doing that. They're seeing that, and they're reading about it. I've had people come in my office and gave me a replay about what the market's done over the last 50 or 60 years before I ever even opened my mouth. So it's a matter of education. It's a matter of being burned once before and not wanting to get involved with it. And it's another thing that's a big factor. They're 10 years older, and now they're getting closer to retirement times in a lot of them, and they don't want to have it. They can't afford to have another 10-year lapse in income. So those 3 factors, the age factor, the fact they're more educated than they've ever been, and they got burned so badly back in 2008 and 2009.
So the fact is that, you got burned in '08. It's 10 years later. You're 10 years older and hopefully 10 years wiser. But the fact is, if they had gone right back in after their losses, they would be well far ahead now, wouldn't they?
They would if for the last 3 or 4 years. There's no question about it, because the market has done about an 84% increase since 2000. We can see the market's been up about 84% since 2000. But most of that, about 75 to 80% of that, is just in the last 3 or 4 years. The truth of the matter is the market's only averaged about 3.8% since 2000. So even then, yeah, they would have been well off if they'd gone back in. They would have been back where they started and maybe a little bit ahead. But when you stop to figure that if you lose 50% in the market, like a lot of people did in 2008 and 9, you got to make 100% back to even get break even. It's not 50%. You got to make 100%. So if you've got $1 million and you're down to 500,000, you're going to have to make enough to make you back up to $1 million. That's 100% on your 500,000. The market hasn't done that across the board. So a lot of people are just now starting to see the light of day. Thankfully, it wasn't a train that ran over them, but the train's on the tracks, and the train's coming again. And the train is sometime within, I would think, within the next a short period of time, could be as short as a year or maybe less, before we're going to see another major market situation that could cause about the same kind of problems that we had 10 years ago.
Wow. That's pretty heavy. So if you're looking at it, you're one of these people who've gotten your education the hard way, the school of hard knocks, as it were. So you're more looking at cash flow,
Sure you are.
Return, rather than just looking for the big appreciation train to roll into the station.
Yeah, exactly. And if you go back and look at the 11 years ago when we had that staggering loss, when Wall Street suffered its worst week in 4 years, all the major indexes that particular time lost between 4 and 6% of their value. But since that time, we haven't really made some of that back. So you really have to be a little bit more careful. I'm finding that the average investor, the guy that comes into my office now, and you made a great point. The point is they're 10 years older and they're wiser. They've been studying this thing. They haven't been listening to the stockbrokers. They've been actually reading and studying for themselves. And I prefer that kind of client because they at least are more aware of what's going on. I don't have to educate the people nearly like I had to do 10 years ago. They come into my office much better educated than they used to be, much more so.
Right. So you're really seeing that there's a degree of sophistication. I guess there's no better teacher than suffering large losses in the market, and they're smart enough to know that, hey, maybe they know more, but they don't know enough.
And that's exactly true. And if you're skeptical of the technical evidence that we have right now, considering what fundamental market analysts are reporting these days, you have to stop and take a look at where we are. The fundamental analysts look beyond the graphs, and they focus on the influencing data, things that are out there on the outside that influence the market. I had a guy tell me the other day, in fact, I was interviewed on another radio station, and the question was asked, what do you think the market is? And I said, it's a bubble looking for a needle. And he said, that's a really good analogy. And I think that's right, because right now specifically, these analysts they're looking at 3 types of financial statements that every company has to share on their balance sheet. They look at their income statement, they look at the cash flow statement, and then they look at what they owe and how much money. And they compare the company's data to that of the competitors, and then they kind of make a choice. Most of my clients that are coming in now have learned how to do that. They weren't doing that 10 years ago. They just did not do that 10 years ago. They just depended on someone else to tell them what was going on. Boy, once you get burned like that, you don't want to get back in without learning how to do it yourself. And while I see a lot of do-it-yourselfers, I also people that say, hey, I realize that I understand what happened, but I need someone to show me that's been here 40 years like I have been. And you've been through more than one of these. Oh, yeah, I've been through 3 or 4 of these situations over the years, and I can give them a little bit better piece of advice as to where they need to go with their investment dollar. So we see in a better educated group of people. That's why people haven't jumped back in quite so quickly.
Right. So when you say you can help them where to go in the market, where do you go?
That's an interesting question. We are most of my clients are more interested in income than they are growth right now. And we are more of an income type doctor than we are a growth doctor, although I have the contracts and I have the licenses to do everything with the brokerage firm that we represent. But most of my clients are looking at putting their money in a really good long-term bond type things. Bonds are still good. I mean, we can get some bonds out there that are in the 4 to 5 to even 6% rating area that are AAAs. They got a guaranteed interest rate, a guaranteed maturity date, and a lot of my clients are looking at that as opposed to the stock market. Some of them are looking at preferreds. Preferreds might be a good place to look because preferreds will provide you a guaranteed rate of interest and they'll provide you a guaranteed income account, and you know what you're going to get out of that regardless of what comes. There's some ETFs out there that we look at. I'm not a big ETF guy because I don't like the word fund, because fund tells me that it's a whole bunch of products rolled up into one, and with the hope that if one goes down, the other comes up and they kind of balance out. But it's been my theory over the years that when the tide goes out, all the boats go down, and you just don't need to be putting your money in situations like that. So we're looking at AAA bonds. We're looking at high-yield bonds. We're looking at some preferreds. Our brokerage people are doing all that work, and they find some pretty good stuff out there. So if a client comes into my office and he's in his 60s and he's thinking about retiring, let's say 10 years down the road. I just had a 53-year-old just a minute ago. When you called, I was doing the paperwork on a 53-year-old. He says, I'm not going to retire until I'm 70. That's the new 65 right now. More and more of my clients are saying, I'm not going to retire until I'm 70 years old. Well, we've got a lot more time to work with their funds, and in 17 years, a 6% bond is going to double almost twice. And if you left it in there, so what's wrong with that? Without the market risk, there's no problem with that. There's no downside to that, as far as I can tell. So that's where we're looking at. We're looking at safety more than anything else.
Yeah. So it doesn't pay to be greedy, and you have to look at it for the long term, obviously, and be happy doubling twice in the next 20 years rather than doubling in the next 3 or 4 years. The story on Wall Street, though, is always the same, isn't it?
Oh, it's always the same, but I don't mind that. I mean, when you talk to a stockbroker, you've got to remember that's what they do. That's why they're called stockbrokers. That's their where they push. But the analogy I tell people all the time is, if you wanted to buy a car and you told the dealer, I need an SUV that'll seat 4 with a carry-on space, and he brings out a Corvette convertible, you say, wait a minute, I didn't really want a Corvette. I wanted an SUV. Well, he says, I got another one. I'll bring you out another one. He brings out another Corvette, and you say, no, you don't understand. I want an SUV. And he said, well, we just sell Corvettes. Well, see, that's kind of what the stock market is. If you go and talk to a stockbroker, they sell stock. That's what they do. But you need to go find someone that can give you if you need an SUV, you want to have somebody that has the SUV. But if you want a Corvette, he can sell you one of those too. So that's kind of what we try to do. We tell people all the time, you buy and you invest the place that makes you most comfortable and you feel like it will do the best for you down the road. Remembering that at one point in time, we're all going to need income. That's what it amounts to. Unless you die early, I tell people all the time, I try to find out programs that will help you whether you live, die, become disabled, or quit. And if we do that, we're looking at things that are a lot more conservative, obviously, but at the same time, my grandfather retired on a pension from Sears Roebuck. It was just an annuity. That's all it was. But he got it for 20 years, and he never had to worry about his checks coming in. And when he died, my grandmother got 50% of it until she died. So there's things out there that you can do that will guarantee your future. And that's really all we're in the business for, is to guarantee people's financial future.
Yeah, that's what it's about, obviously. So, one thing you can count on Wall Street is they're going to be telling you it's always a good time to buy, no matter what.
Oh, absolutely.
Right? How do you defend against that? And
I really don't try to defend against it. What I do, it's always a good time to buy, except that if you're there and you just bought and you're just retired and the market cratered, I don't have any problem. One of the first questions I ask my clients when they come in the office is, do you consider yourself a conservative or an aggressive investor? I want to really find out what their attitude is. I'm in West Texas, for crying out loud. 99% of the people walk in the door are going to be conservatives. That's just the way it is. But the next question is, being a conservative investor, how comfortable are you with the stock market, and what percentage do you think ought to be in the stock market for your own investments? And I get everything from 50% up to 80% to 20%, and it depends on the age of the individual and how badly they got burned 10 years ago. If they got burned 10 years ago, I hear I hear, especially if I have a husband and wife, it's funny how that works. The husband will say, well, I think we ought to have at least 25 or 30% in the market. And the wife will say, I don't think we ought to have anything in the market. I can remember when we lost all that money. It's kind of like, using a country expression, if women could remember the pain of childbirth, we'd all be only children.
Yeah.
If we could remember what happened in the market 10 years ago, but we have a very, very short-term memory when it comes to that sort of thing. We forget the pain, and we can only remember the gain. So what we have to do is at least educate the people as to the fact that we're looking at another one of those type situations, I think, right around the corner. I really believe it's imminent. And if it does, we're going to wake up, and it could be bigger than the last one. Historically, it always is. The third drop in what we call a secular bear market, and that's kind of where we are, the third drop over the last years, for the last 120 years, has always been the biggest. We've only had two. We had one in 2000. That went all the way to 2003, basically. Then the one in 2008 and 9. We haven't had that third one yet. We're looking at that. And if that happens, it could be. And if it's historically what it has been in the past, it will be larger than the one in 2009. So we want to prepare the people for that.
Well, that old maxim, you never go broke on Wall Street taking a profit, right?
Yeah. If you can get out with a profit, my idea is get out. And where the market is today, people that are buying in, there may be another 5 or 6 or 7% growth factor in the market, but there's also a potentiality of losing 50%. And I just spoke at a major conference in Las Vegas a couple of weeks ago for a large insurance company, and I told the 300 some odd guys that I was talking to, I said, you can walk right down the hall and put a $100 bill on the table, and you might make money. But if you walked up to a table that said, if you win with your $50, we'll give you $7. But if you lose, we take your $50. Would you sit down? And not a guy in the room would. And I said, that's basically where we are right now with the market. We may have another 5 to 7% growth in the market over the rest of this year, but there's a real strong potential, perhaps, of losing at least 50%. That's kind of where you are. And I don't think most people would take those kind of odds in Las Vegas, and they sure shouldn't be taking it with their retirement money.
Yeah, that is a great point. Hey, you look at it, how much do people really learn from their experiences before? Or the definition of insanity is always, doing
exactly.
The same
In fact,
thing
you're quoting a friend of mine when you talk about that. David Scranton, who is a business associate of mine, wrote a book called Financial Insanity, and that's a point that he makes in that book. And I really think that people ought to take a look at his book on financial insanity. And he's a brilliant guy, but that's the point he makes. If you keep on doing it the same way and expecting different results, that's exactly what's going to happen. You're going to get different results, all right, but it's going to be stuff that's not going to be good for you financially.
Yeah, it reminds me of someone else who once said, no one ever went broke underestimating the intelligence of the American people, right?
That's true, and I know who you're talking about, and that's basically what I've run across in the last, I'd say the last 3 or 4 years, especially with my clientele. I do seminars, and I notice that the questions that are asked me in seminars are much more thoughtful. They're more thought-provoking. They're educated questions. People have obviously read up before they ever come to the seminar, and they will ask me questions that I was not being asked 10 years ago. Now people are learning, and they're figuring out a better way to control their own situations, and I really encourage that. I like to educate my clients. In fact, I've been told I'm a better educator than motivator, and if that's the case, because I think education does motivate people to do the right thing and to make the right decisions.
Yeah, so education, but the right education.
Absolutely.
Yeah. So the right education, obviously, David Scranton's book for sure, but there's other places you need to be looking as well.
Oh, absolutely. I think that's just one spot. There's a guy named Jeffrey Small that's got a new book out called Turning Retirement Planning Right Side Up, and I can recommend that book very highly, too. Jeff's a good friend of mine also, but he's got one called Turning Retirement Planning Right Side Up, and I think all these books you can get on Amazon.com, but those two books are good that you need to take a look at. If you're conservative, you need to look for the kind of conservative people that are in that area that are trying to use bonds and bond-like instruments in order to protect their clients' future and their retirement plan. That's really what we do, and what I really think that's what everybody in our field ought to be doing right now. To protect what you've made, the ones that have made some good returns, protect those returns, and at the same time guarantee the future for them down the road if the market does take a downturn. And, if it doesn't, I'll be the most surprised guy in the world.
I can only imagine. Every boom ends with a bust, right? I mean, isn't that the way it works?
Yeah, exactly. You're exactly right. We just try to plan it so that the people can see what all the ins and outs are and what the opportunities are and where they're going to go with it. And if we get the right answer, and we have been very fortunate here in Midland, we've been here for 42 years now doing what we do. And it's something that if you don't do the right thing in a small town, you won't be there that long. So I guess I've been doing something right over these years.
Yeah, you'll get run out of town on a rail, as they say. Right?
Well, that's the old story about the guy that got ridden out of town, tarred and feathered and ridden out of town on a rail. And he said, if it wasn't for the honor of this situation, I'd just about as soon walk. And I just don't want to get caught in that trap.
Nah, nobody does. Nobody does. Ounce of prevention, as they say, right? So,
Absolutely.
Yeah. So if people want to find out more about you, what you're doing, how you're practicing what you preach, where do you go?
Well, you can go to retirementIncome.com. We have a website there. You can actually email me. I get clients all the time. People just email me. It's dkcart, D-K-C-A-R-T @hotmail.com. And I get people from all over the country asking me questions, and that's fine. And I do have a book coming out in May that I would recommend people take a look at. It's called It's Now or Never, or How to Enjoy Your Life and Not Let Your Investments Own You. It should be out by about the end of May. You'll be able to get it on Barnes & Nobles and Amazon.com, and I'd recommend reading that book, obviously, since I wrote it. But all these things are things that people need to do their research. They really do. We'll be glad to talk to anybody that wants to talk to us and gets in touch with us. We're anywhere in the country. We can do that.
All right. Hey, well, we'll have a link to Dee's site on the show notes to this interview on financialsurvivalnetwork.com. Hey, again, be part of the conversation. Email us, kl@kerrylutz.com, or just call the hotline, which is 914-424-4142. The Twitter feed, for those of you into tweeting, is @KerryLutz. The Facebook page, Financial Survival Network. And Dee, it's been enlightening. Thanks so much for stopping by.
You bet. Glad to do it. I hope to talk to you again sometime soon.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.